$9 trillion in additional global liquidity has picked the S&P 500 off its March lows and pushed it above its prior record closing high, but it couldn't hold. So it seems that maybe we aren't trading on the fundamentals. With this backdrop, Warren Buffett once wrote that investors would have seen the dot-com crash coming from a mile away had they paid attention to what he described as probably the best single measure of where valuations stand at any given moment. The measure is currently very high by historical standards. So why then is Buffett buying? Well, let's take a look. Known as the Buffett indicator, and one that we've talked about before, the measure is simply the total market cap of all U.S. stocks relative to the country's GDP. When the measure is under the 80% range, that might be a good time to be investing. When the measure is above the 100% level, that's a signal to take your foot off the gas. But as this chart here shows, we're above the 120% range, so maybe we're a bit overvalued. Now, there are several variations to the Buffett indicator, and this chart from Advisor Perspectives shows the corporate equities to GDP. And the most recent measure shows the current level is at 131.4%, which is up from the first quarter measure of 123.3%. But also notice that the measure right before the dot-com bubble was 159.2%, and just before the great financial crisis, the measure was just under 120%. Now, in terms of the dot-com bubble, the current measure doesn't look too bad. But just wait. And this chart here is another variation and maybe a more transparent alternate snapshot over a shorter time frame. And this chart goes back to 1970 as opposed to the previous chart that went back into the 1950s. And this uses the Wilshire 5000 full cap price index divided by the GDP. And many consider the Wilshire Index a more intuitive, broader metrics of the market. But as you can see with this chart, we're at a record high of 152.8%, with the level just before the dot-com bubble at 136.9%, and the level right before the great financial crisis at 105.2%. So, if we are so high on this measure, why is Warren Buffett buying stock like Bank of America? And this chart shows that maybe we're not so high on the valuation after all. And this chart here is the first chart we saw earlier, but with a twist. It includes the same data as before, but included is an exponential regression line. Using this perspective, maybe things are not so overvalued as we thought. However, the fact remains that we're well above the 100% line, we're above the regression line, and we are at historically elevated levels. Regardless of what these charts show, Warren Buffett may be buying because banks fall well below these thresholds. And as we've seen recently, banks may be nearing a bottom. And although these charts do provide an interesting perspective, they're not necessarily reliable for timing your investment. Overall, as I've mentioned recently, these charts do indicate that with everything going on, we need to step back, take another perspective, but always be cautious and patient. As for me, you know that I've done some selling recently, but I'm still over 75% invested. I'm taking some profits off of the table and making sure I have plenty of cash if the market turns. And if it turns, you'll likely be the first to know if you follow this channel. And so for today, that's ChewDog Charts. Thank you.